What a significant bounce today. The market is seeing this move back over the last 2 days after suffering its worst weekly performance all year. And then we have today, this rally, unbelievable. However, it doesn't mean you've missed out on some good bargain buys. We're bringing back Jeff Reeves. He's editor of InvestorPlace.com. He's been trolling, picking through all the balance sheets. He's got 3 names right now that he absolutely loves. But first, is there an overall theme before we get to these names?
Yeah, I think that what I'm kind of looking for right now is companies that are not up against a 52-week high. I think anybody can kind of pick some the momentum darlings that are out there right now. But a lot of investors who are a little worried about how frothy it is in tech or financials, you might want to consider buying a stock that for some reason has kind of sat out the rally and seems like it's turning around. There are risks in some of these plays, obviously, for obvious reasons that we'll get to. But I think that you might be better served trying to buy one of these companies on a pullback, considering they haven't already run up 50, 60% year to date.
Right. So it would be the Starbucks from 7 months ago, if you will, before it started hitting multiple 52-week highs. Let's get to your first pick. It is Goodyear. This one down 14% just over a month.
Yeah, and personally, I own Goodyear now in my portfolio. I just bought it last week because I think it's a great turnaround story. It's one of these American companies where it's really not a sexy name, but Goodyear has a lot of things going on for it. It's restructured over the last couple years. It's tried to get its debt down. It's tried to kind of deal with union contracts. It's divested its farm tire operations in Europe and in South America. So the company is kind of evolving, and it's actually profitable again. And if you look at the earnings, its fiscal 2012 earnings are set to double compared to last year. But for some reason, the company continues to sit it out. It's got a PE of 7 right now. So if you look at the broader auto industry, I think there are updrafts going on right now. We saw 10% growth in domestic auto sales in 2011. It looks like we're going to see another good year.
Got it.
So, pardon the pun, I think Goodyear's going to have a good year. It's a decent opportunity for someone who's not looking to buy a stock at a 52-week high, like you said, like Starbucks. But I think there are reasons to think the stock is turning around right now.
Okay, so yeah, we were waiting for that pun. Now you're ignoring Gordon Gekko's suggestion that guys like me have gotten our tuchuses in a sling over airlines. You like Southwest, a low-cost airline. This one, an $8 stock right now, but it's off the 52-week high of about $12.44. Where's this going?
Yeah, well, to be clear, I don't think that anyone should really buy and hold airlines right now. Everybody should know the risks. If they don't, you got whatever you want to call it, sawdust for brains, because it's a highly regulated industry. Fuel prices really weigh on these companies, and every couple years, a big major player goes bankrupt. So that should tell you right now it's not a buy and hold investment. But as a swing trade, I like Southwest, because if you look at some of the other airline stocks, they've had a lot of pop. Southwest hasn't, yet its earnings were set to rise from, I believe, 23 cents a share to 67 cents a share in fiscal 2012. That's a huge increase. Now, Southwest reports earnings this week. It's not going to be as good as they previously had said. They may even post a quarterly loss. So I expect the stock is probably going to get beaten down. You might want to see that as an opportunity. Like you said, it's at 8 now. If it gets down to the mid-$7 range, if you look at the 52-week high, that's a lot of upside from here. Even if it doesn't get that far, if it only gets back to $9, $10 a share, you have a significant swing trade. Again, not a buy and hold investment, but I think you can get back up to $9 a share. So
Goodyear, Southwest, and now your number 3 bargain pick. This is Corning, and I like looking at the ticker and explaining to people GLW. Corning stands for GLW Glass Works, because of course they've had big glass company business, and now they have Gorilla Glass, which is going on all of the tablet covers and the smartphone covers. What's behind your feel that this is the company? And there I am kicking it.
Well, no,
I've tried everything, kicking the glass away at CES.
Well, and that's a great thing that it's got going for it. Yeah, at CES in 2012, it's got Gorilla Glass 2.0 coming out. It's a cover of smartphones and tablets. It's this very durable, non-scratch, conductive glass that's on the face of all your fancy gadgets. But a lot of people still think Corning is kind of this outdated, old business. It's really not. It's got LCD panel business. It's 40% of its revenue. 25% of its revenue comes from fiber optics. So this really is almost a tech company. And while there is trouble in the LCD market, that's actually one of the reasons why Corning has guided down for its upcoming earnings report. I do believe that just organically, this sector is really growing well, at least the kind of what Corning does with glass in technology. And even if it does kind of stumble sideways for a little while, it's got a low PE of a little less than 10 right now. It's got a 2.2% dividend. So maybe you're catching a falling knife in some of these stocks, but you at least have an incentive to stick around. Jeff, I like Corning for the long term.
Great to have you. You're our BFF for great ideas. Jeff Reeves, InvestorPlace.com editor, and we'll put those names, all of them, up on the Facebook.com/AfterTheBell page. See you next time.